You can read charts and understand market trends, but the moment real money is on the line, fear changes your decisions and greed makes you break your rules. That's why nearly 90% of traders lose money. The real problem isn't your strategy, it's your psychology. Most traders treat the market like an emotional game instead of following a disciplined plan. The first secret is emotional detachment. Every time you enter a trade, your mind is controlled by two emotions: fear of losing money and greed for bigger profits. These emotions force you to make impulsive decisions instead of following your strategy. Professional traders think differently. They know that trading is a probability game, not an emotional drama. Just like a professional poker player, they understand that every trade is only one outcome in a long series of trades, not a guarantee. If you want to become a consistently profitable trader, stop trading with emotions and start trading with probabilities. Master your mindset first, and your results will follow. Professional traders don't look at every trade emotionally. They treat every position as nothing more than a statistical advantage. To them, each trade is just one event in a long series of trades. But what does the average trader do? Most traders treat every single trade as if it determines their entire future. They believe, if this trade wins, my life will change. If it loses, everything is over. This mindset is exactly what leads to repeated losses. Have you ever wondered why large hedge funds and professional traders make money consistently? It's because they don't trade based on emotions. They rely on data, risk management, and a proven strategy. Every trade is viewed as an independent event, not as a source of hope or fear. That's why they never panic sell. They don't enter trades because of FOMO, fear of missing out, and they don't let emotions control their decisions. Most importantly, they accept losses quickly, learn from them, and move on to the next opportunity. This is the mindset you need to develop. Whenever you take a trade, treat it like a machine would. Your entry, stop loss, and exit should all be planned before you enter the market. Once you're in the trade, there should be no emotional decisions. If the market moves against you, follow your trading plan and exit according to your predefined rules. Never think, maybe the market will come back, or, if I exit now, I'll lock in my loss. That kind of thinking keeps traders stuck in losing positions and often turns small losses into devastating ones. At this point, some people might ask, I understand that I need emotional detachment, but how do I actually practice it? The first step is to stop expectation-based trading and start rule-based trading. Expectation-based trading happens when you place unrealistic hopes on every trade. For example, you buy a stock and immediately start imagining how much money you'll make. You expect the trade to be a big winner before the market has even confirmed your idea. This creates emotional attachment, and once emotions take over, your decisions become irrational. Instead, focus only on following your trading rules. Judge your success by how well you executed your plan, not by whether a single trade made or lost money. Remember, consistent profitability doesn't come from predicting every market move. It comes from following a disciplined process over hundreds of trades. That's how professionals think, and that's the mindset that separates successful traders from everyone else. You buy a stock believing it's almost guaranteed to move 20% higher. But when the market does the exact opposite and starts falling, fear immediately takes over. At that moment, most traders make one of two common mistakes. They either panic and close the trade too early, locking in an unnecessary loss, or they enter what I call hope mode. In hope mode, traders convince themselves that the market will eventually come back. They remove their stop loss, ignore their trading plan, and keep holding the losing position. Unfortunately, this mindset slowly destroys trading accounts because the market doesn't care about your hopes, wishes, or expectations. The market moves according to supply and demand, not according to what you want to happen. This is where rule-based trading becomes so powerful. In rule-based trading, every decision is made before the trade is placed. You simply follow your trading strategy without letting emotions interfere. For example, if you've decided that your maximum stop loss is 1.5%, then you never move or remove it, no matter what happens. If your trading plan requires a 1 to 3 risk-to-reward ratio, you patiently stick to that target instead of panicking over every small price fluctuation. Your job isn't to predict every market move. Your job is to execute your trading plan with consistency and discipline. Now here's one of the most powerful mindset shifts you can make. Stop treating each trade like it's special. Start treating every trade as just another number. At first, this idea may sound strange, but it's one of the biggest differences between amateur traders and professionals. Think about how a professional casino owner operates. I'm not comparing trading to gambling. I'm talking about the professional mindset behind it. A casino owner knows that some players will win and some will lose. They don't become emotional after every game because they understand that their long-term statistical edge will generate profits over time. Successful traders think exactly the same way. They understand that no single trade determines their success. Every trade is simply one event in a large sample of trades. Some trades will be winners, some will be losers, but as long as they continue following a profitable strategy with proper risk management, the probabilities will work in their favor over the long run. When you begin viewing trading through the lens of probability instead of emotion, fear starts to disappear, greed becomes easier to control, and your decision-making becomes far more consistent. That shift, from emotional trading to probability-based thinking, is what separates consistently profitable traders from those who struggle year after year. So, what's the benefit of treating every trade as just a number? The biggest advantage is that your emotions stop controlling your decisions. When you stop attaching emotions to individual trades, your mind becomes much calmer. If a trade ends in a loss, you won't take it personally. You won't think, the market betrayed me, or I just need a secret strategy that wins 100% of the time. Instead, you'll simply accept it as one normal losing trade, nothing more, nothing less. And move on to the next opportunity. This is exactly how successful traders think. If you can develop this mindset, you'll have a chance to join the small percentage of traders who consistently make money in the markets. But if you continue treating every trade like a battle that you absolutely must win, you'll trap yourself in a cycle of frustration, revenge trading, and overtrading. So ask yourself a simple question. Do you want to treat trading like a professional business, or do you want to keep riding an emotional roller coaster that slowly drains your hard-earned money? If your answer is the first option, then start practicing emotion-free trading today. Focus less on the outcome of each individual trade and more on the quality of your process. When your process becomes consistent, the profits will eventually follow. Now let's move on to secret number 2, risk management is your greatest weapon. The real secret to winning in trading isn't a magical strategy or a perfect indicator. It's risk management. You could have the best trading strategy in the world, but if your risk management is poor, the market will eventually wipe out your account. This isn't an exaggeration, it's reality. The majority of traders fail not because their strategy is bad, but because they don't know how to control risk. They approach the market as if every trade is a chance to hit the jackpot instead of treating trading as a business built on managing risk. Professional traders understand one simple truth. Protecting your capital is more important than chasing profits. Because if you protect your capital, you'll always have another opportunity to trade. But if you lose your capital, your trading journey ends. So the real question is, are you focused on making money? Or are you focused on staying in the game long enough to become consistently profitable? The traders who survive and succeed always choose the second option. Have you ever wondered how professional traders generate consistent profits year after year? The answer is surprisingly simple. They follow one powerful principle. Survival first. Profits later. Their primary goal isn't to make money on every trade, it's to protect their capital. Because they understand one important truth. If you stay in the game, you'll always have another opportunity to make money. But if you lose your capital, the game is over. That's why professional traders never risk their entire account on a single trade. Instead, they use a fixed risk on every position, typically between 1% and 2% of their total trading capital. Let's look at a simple example. Imagine you have a trading account of $10,000, and you risk only 1% per trade. That means your maximum loss on any single trade is $100. Now, even if you lose 10 trades in a row, your total loss would be only $1,000. You would still have 90% of your capital available, giving you plenty of opportunities to recover when your winning trades arrive. Now compare that with traders who ignore risk management. If you risk 20% or 30% of your account on every trade, it only takes 3 or 4 losing trades to destroy most, or even all, of your trading capital. And that's exactly what happens to many beginners. They convince themselves, this next trade will recover everything. But the market doesn't reward hope. The market rewards discipline. Only traders who manage risk properly survive long enough to become consistently profitable. Another major mistake traders make is ignoring their stop loss. Some don't use one at all, while others place it randomly without any logical reason. Both approaches are dangerous. Your stop loss isn't your enemy, it's your trading lifeline. It's the tool that protects your account from catastrophic losses. Without it, a single unexpected market move can wipe out weeks, months, or even years of hard-earned profits. What's even more common is that traders set a stop loss, but as soon as the market moves against them, they remove it. Why? Because they start thinking, maybe the market will reverse. Maybe I should just give it a little more room. Unfortunately, this is where small losses often turn into account-destroying disasters. Remember this. The market doesn't care about your emotions. It doesn't know where you entered. It doesn't know how badly you want the trade to work. And it certainly won't reverse just because you're hoping it will. Successful traders accept that losses are part of the business. They respect their stop loss, protect their capital, and move on to the next opportunity. That's the mindset that keeps them in the game, and ultimately makes them profitable over the long term. So, how do you actually apply proper risk management? It's much simpler than most people think. The first step is to define your risk before you place any trade. Ask yourself one simple question. How much am I willing to lose if this trade doesn't work out? Decide that amount in advance and never exceed it. For example, if your maximum acceptable loss on a trade is $100, then calculate your position size and set your stop loss accordingly. Never enter a trade first and think about risk later. Professional traders always calculate their risk before they calculate their potential profit. The second step is to plan both your entry and your exit before entering the market. Before placing a trade, already know the answers to these questions. Where will I enter? Where will I take profit? Where will I exit if the trade goes against me? When these decisions are made in advance, there's no need to make emotional choices while the trade is running. Your plan makes the decisions, not your emotions. The third rule is to maintain a healthy risk-to-reward ratio. Aim for at least 1:2, and ideally 1:3. That means if you're risking $100, your target profit should be at least $200 to $300. This approach gives you a huge long-term advantage. Even if you don't win every trade, a favorable risk-to-reward ratio allows your winning trades to more than cover your losses. In many cases, just 2 or 3 well-executed winning trades in a month can be enough to keep you consistently profitable. Now ask yourself, are you treating trading like a game, or are you treating it like a professional business? If your goal is to make one lucky jackpot trade, you might ignore risk management. But if your goal is to trade successfully for years, then risk management is not optional, it's essential. Because in trading, the people who make the most money are usually the ones who first learn how to protect it. Now let's move on to secret number 3, how to avoid FOMO trading. What is the most dangerous enemy of every trader? It's FOMO, fear of missing out. FOMO is that powerful emotion that makes you believe you're about to miss the next big move. It pushes traders to chase the market, abandon their strategy, and make impulsive decisions. And for many traders, that single emotion is responsible for some of their biggest losses. Fear of missing a big move. That single emotion destroys more traders than almost anything else. Whenever the market suddenly starts rallying or a stock or cryptocurrency shoots up like a rocket, a voice inside your head says, "If I don't enter now, I'll miss the opportunity." And that's exactly where most traders make their biggest mistake. Driven by urgency, they jump into a trade without thinking, without a plan, and without considering the risk. Then, just as they enter, the market reverses. So why does this happen? Let's understand the psychology behind it. When a stock has already moved up 5% to 10%, beginner traders start believing it will continue rising forever. They rush to buy because they don't want to miss the next leg higher. Professional traders, however, see the situation very differently. They know that after a strong rally, emotional buyers are likely to enter the market. Instead of chasing the price, professionals often begin taking profits and gradually closing their positions. In other words, when you're buying because of FOMO, experienced traders may already be selling to you. But FOMO isn't limited to buying. It also appears during market crashes. When prices fall sharply, inexperienced traders panic and sell immediately because they're afraid of losing even more money. Professional traders do the opposite. They understand that fear often creates opportunities. Instead of panicking, they patiently look for high-quality buying opportunities when others are rushing to exit. That's why you've probably experienced this before. You panic, close your position, and almost immediately afterward, the market reverses and starts moving in the direction you originally expected. Then you think, "I should have just held my position." So, how do you avoid FOMO? The first rule is simple. Stop trying to trade every market move. The market produces thousands of signals every week, but that doesn't mean you have to act on all of them. Trading isn't like cricket, where you have to hit every ball. In fact, one of the biggest strengths of successful traders is knowing when not to trade. If you react to every price movement, you'll quickly exhaust both your capital and your confidence. The second rule is just as important. Never enter a trade without a clear plan. If you don't know exactly why you're entering, where you'll exit, and how much you're willing to risk, then you're not following a strategy, you're simply reacting to your emotions. And emotional trading is exactly what FOMO wants you to do. The second rule for avoiding FOMO is simple. Never take a trade without a plan. Remember this. No plan is equal to gambling. If you enter a trade without any logical reason, simply because other people are buying or selling, you are no longer acting like a trader. You're gambling. Successful traders don't follow the crowd. They follow their trading plan. Before they enter any position, they already know exactly where they will enter, where they will exit, how much they are willing to risk, and where they will take profits. That preparation is what separates professionals from amateurs. The third rule is to trade only A-plus setups. In other words, only take trades that perfectly match your strategy and meet all of your predefined conditions. Don't jump into every small market movement. Wait until a trade checks every box on your trading checklist. If the setup isn't there, don't force a trade. Remember, patience pays. Overtrading destroys. Professional traders may analyze dozens of charts and setups every day, but they often take only one or two high-quality trades. They understand that making fewer, better decisions is far more profitable than constantly chasing the market. So ask yourself, will you keep jumping into every market move because you're afraid of missing out? Or will you develop the discipline to wait patiently for the right opportunity, just like professional traders do? If you truly want to become consistently profitable, you must learn to control FOMO. Otherwise, the market will teach you that lesson the expensive way. Now let's move on to secret number 4, how to control greed in trading. Greed is one of the biggest reasons why the majority of traders keep losing money. It causes traders to make irrational decisions that destroy even good trading strategies. Have you ever noticed this? The moment your trade shows a small profit, you're tempted to close it immediately because you're afraid the profit might disappear. But when the trade starts moving against you, instead of accepting a small loss, you remove your stop loss and hope the market will recover. This is completely backward. It's one of the most damaging psychological mistakes a trader can make. Think about why this happens. The moment you see a few green candles and your trade turns profitable, your brain becomes excited. You start imagining bigger gains, and at the same time, you're afraid of losing the profit you already have. That emotional conflict often leads to poor decisions, and over time, those decisions can cost far more than any single losing trade. Your brain tells you, what if this profit disappears? I should take it now. So you close the trade too early. But when the same trade starts moving against you, your mind suddenly changes. It whispers, just wait a little longer, maybe the market will come back. And that's where most traders make their biggest mistake. They take small profits quickly but hold on to large losses, hoping they'll eventually recover. This single habit destroys more trading accounts than almost anything else. That's why so many traders end up with a trading history that looks like this. 5 small winning trades, followed by one massive loss that wipes out all the profits, and often much more. So, how do you overcome greed? Rule 1, maintain a healthy risk-to-reward ratio. Always aim for at least a 1:2, and ideally a 1:3, risk-to-reward ratio. For example, if you're risking $100, your target profit should be at least $200 to $300. With this approach, you don't have to win every trade. Even if only 4 out of 10 trades are successful, you can still be profitable over the long run. Rule 2, define your target and stop loss before you enter. Never enter a trade until you've already decided exactly where you'll take profit and where you'll exit if you're wrong. Once you're in the trade, stick to your plan. If you make decisions based on every price movement, your emotions, not your strategy, will take control. And that's one of the biggest traps in trading. Rule 3, let your winners grow. Professional traders allow profitable trades to develop. They don't rush to take profits simply because they're afraid of giving some back. New traders, however, often grab tiny profits at the first sign of success. That fear of losing unrealized gains prevents them from capturing the big winning trades that make a trading strategy profitable. Remember this simple principle. Cut your losses quickly. Let your winners run. That's how professional traders build consistent long-term profits. Now let's move on to secret number 5, how to develop the right trading mindset. The market is not a money-printing machine. But if you train your mind the right way, it can become one of the greatest wealth-building opportunities available. Because the real game isn't just about making money. It's about building the mindset that allows you to make good decisions consistently. Money is simply the result of that mindset. The traders who succeed aren't necessarily the smartest. They're the ones who think differently, stay disciplined, and keep following their process, even when their emotions try to pull them in another direction. Successful traders earn consistent profits because they treat trading like a profession, not like gambling. Think about it for a moment. Could a doctor perform surgery without years of education and practice? Could an engineer build a safe bridge without learning the fundamentals first? Of course not. So why do so many people believe they can make money from trading without developing the right mindset, building the necessary skills, and putting in consistent practice? The truth is, most traders don't fail because the market is too difficult. They fail because of the way they think. Many beginners believe trading is simple. They open a chart, learn a few technical indicators, place a trade, and expect money to start flowing. Then, when they lose, they blame the market. The market is manipulated. The market is unfair. But in many cases, the real problem isn't the market. It's an undisciplined mindset. So, how do you develop the mindset of a professional trader? Step 1. Keep a trading journal. If you don't track your trades, you'll keep making emotional decisions without realizing it. Record every trade you take. Write down why you entered the trade, your entry and exit prices, whether you followed your trading plan, the final result. Most importantly, what you learned from the trade. A trading journal turns every mistake into valuable feedback. If you don't understand your mistakes, you can't improve them. Step 2. Learn from your mistakes instead of repeating them. One of the biggest mistakes a trader can make is repeating the same errors over and over again. For example, your stop loss gets hit, so next time you move it farther away. Or you take profits too early and promise yourself you'll wait longer next time, only to make another emotional decision. Without reflection, the cycle never ends. Eventually, those repeated mistakes can drain your entire trading account. Professional traders don't pretend mistakes never happen. They study them, learn from them, and use them to improve. Step 3. Focus on the process, not just the money. People who chase money usually make emotional decisions. People who focus on making high-quality decisions are the ones who eventually earn consistent profits. Your goal should never be to make money on your next trade. Your goal should be to follow your trading plan perfectly. When you consistently execute a profitable strategy with discipline and proper risk management, profits become a natural result. Remember this. The market rewards discipline, not desperation. The moment you stop chasing money and start mastering your process, you begin thinking like a professional trader. And that's the mindset that separates the small percentage of consistently profitable traders from the majority who never reach their full potential. The traders who focus on making the right decisions are the ones who win in the long run. That's why your attention should always be on 3 things. Making the right entry. Following the right exit. Managing your risk properly. When you consistently execute these 3 principles, profits become the natural outcome. Always remember. Money follows discipline. It doesn't chase emotions. One more thing. The traders who make consistent money are usually the most patient. They don't spend every minute staring at charts, wondering, should I buy now? Should I sell now? Instead, they wait calmly for high-probability opportunities that match their trading plan. Patience isn't weakness. It's one of the greatest competitive advantages a trader can have. Now the choice is yours. Will you continue following the 90% of traders who lose because they trade with fear, greed, and emotion? Or will you change your mindset, develop discipline, and start trading like a professional? These were the 5 powerful secrets that can completely transform your trading psychology and help you become a more disciplined and consistent trader. If you found this video valuable, make sure to hit the like button and share your biggest trading challenge in the comments below. I'd love to know what you're struggling with, and it may even become the topic of a future video. And if you're serious about improving your trading mindset and learning strategies that focus on discipline, risk management, and long-term consistency, don't forget to subscribe to the channel and turn on notifications so you never miss the next lesson. Thank you so much for watching, and I'll see you in the next video.